In this lecture, we're going to begin our discussion about some classic economic decision criteria. In particular, we're going to discuss future worth, present worth, and annual worth. As we discussed in the preceding lecture, an economic decision criterion is comprised of two components, a measure of worth and a decision rule. The measure of worth for future worth can be defined two ways. One way is to define it as the difference between the prospective benefit minus the prospective cost, where I here is the minimum attractive rate of return. We could expand on that definition by substituting in the formulas that define prospective benefit and prospective cost. And I can simplify that formula this way, that is, it's the difference between the benefit series and the cost series compounded and or discounted to a common point in time, capital T, which, since we know that the difference between benefits and costs is nothing more than the net cash flow series, AJT, then I can define the future worth as nothing more than the sum of all of the net cash flows from time 0 to time n, compounded and or discounted to a common point in time, capital T. Capital T typically is n, that is, the planning horizon for the cash flow series. We said every criterion has a measure of worth and a decision rule. We said it made good economic sense to accept an opportunity J when its benefits exceeded its costs. If that is true, then it should make good economic sense to accept an opportunity J when its future worth is greater than 0. Otherwise, we'll reject. Let's take an example, and let's revisit an example we talked about in the last lecture. Just to refresh your memory, we introduced a situation where we had a manufacturer that was considering the purchase of 10 robots. Those robots were to cost $200,000 each with an expected life of 9 years. It would cost $45,000 to install those robots. It would reduce our labor costs by $50,000 a year. It would increase our energy costs by $15,000 per year. Our minimum attractive rate of return was 10% per year, and we wanted to know whether those robots were economical. Again, what we need to do is to translate this problem statement into its net cash flow series, which would be represented this way. That is, the decision before us is it worth spending $2,045,000 to save $350,000 each year for the next 9 years? And we could also identify its component benefit series and cost series as shown here. The benefit series is the $350,000 in savings I will have each year for the next 9 years. The cost series is shown here, and that is simply the singular cash flow of $2,045,000 at time 0. To solve this problem using future worth, I can do it one of two ways. I can either use the definition of future worth, that is, it is the difference between the prospective benefit and the prospective cost. If I do that, what I need to do is to calculate the future amount, an equivalent future amount of this cash flow stream as of time 9, and an equivalent future amount of the cost series as of time 9. We did that in the last lecture, and we showed that the prospective future benefit, that is, an equivalent amount F as of time 9, when one could invest these benefit cash flows at a minimum attractive rate of return of 10% per year, would result in $4,752,800. Whereas the prospective cost, that is, a future amount that's equivalent to that cost as of time 9, resulted in an amount of $4,822,000. Taking the difference between these two numbers, The result is the future worth is $69,200. That is a minus $69,200. Since that is less than zero, we reach the same decision as we did before. Installing the robots is not an economical course of action. Alternatively, I can calculate the future worth by working directly with the net cash flow series. That is, what I want to do is to find a future amount, F, that is equivalent to that cash flow stream as of time 9. To do that, I can write the equation this way. The future worth on these robots, when I can invest at 10% per year, is the initial cost of $2,045,000 taken as a single amount and moved forward in time to a future amount. Find F, given P, and I can invest at 10% per year for 9 years, plus the future worth of these net cash flows, that is the savings for each year for the next 9 years, treated as a uniform stream of $350,000 per year, times the equivalence factor. Find F given A, when I can invest at 10% per year for 9 years. I do the calculations, and of course I get the same result, minus $69,200. Again, the robots would not be economical. Now, we can do these calculations, but let's be certain we understand the economic interpretation of what these numbers mean. If I, in fact, install the robots, I will receive this benefit series for the next 9 years. And when reinvested at 10% per year, I would accumulate $4,752,800. Alternatively, if I do not install the robots, then I prefer to have this cash flow stream, the cost series, in which case I will not invest the $2,045,000 in the robots, but instead would invest that at my minimum attractive rate of return, and that would accumulate to $4,822,000. Notice, future worth, measure of worth, future worth is an expression of the relative worth or value that I will accrue from a decision to accept or reject this cash flow stream. In other words, by accepting the robots, by installing them, this says I would be poorer, that is, less well off, by $69,200. It's a relative amount, meaning the increment that I would incur as a consequence of accepting or rejecting that cash flow stream. It is not an estimate of my total wealth. If I wanted to know what my total wealth would be from investing in these robots, it's $4,752,800. My total wealth by not investing in the robots would be $4,822,000. Future worth simply expresses the relative amount that I would incur as a result of a decision to accept or reject, meaning if I, in this case, invest in the robots, I would be less well off by $69,200. Let's now talk about the next economic decision criterion, present worth. Present worth can be defined this way. The present worth of an opportunity J is nothing more than its future worth discounted back in periods, that is, to time 0, where again, I here is the minimum attractive rate of return. I can substitute in here the expression to calculate future worth shown here, that is the sum from time 0 to time n of the net cash flows, AJT, compounded and or discounted to a common point in time, capital T, and all of that discounted back in periods. Or, simplifying that simply, the net cash flow series, AJT, from time 0 to time n, discounted back to time n. We said it made good economic sense to accept an opportunity when its future worth was greater than 0, so it should make good economic sense to accept an opportunity when its present worth is greater than 0. Let's take another example. Let's assume an engineer is evaluating 3 alternative routes for a power line. And for this decision, the minimum attractive rate of return is 8% per year, and the planning horizon is 15 years. And we have the following information for these 3 routes. The first route, the length of that route is 15 miles. For Route 2, it is 5 miles, and for Route 3, it is 10 miles. The cost of construction per mile for each route is also shown. It's $5,000 per mile for Route 1, $25,000 per mile for Route 2, and $10,000 per mile for Route 3. The annual maintenance costs also vary depending upon the route. The maintenance cost for Route 1 is $200 per mile. Route 2, it's $400 per mile. And Route 3, it's $250 per mile. The salvage value for Route 1 is $3,000 per mile. For Route 2, it is $5,000 per mile, and for Route 3, it's $3,500. The power loss along these 3 routes is the same on a per-mile basis. That is, each will lose an equivalent of $500 per mile. The total power loss, however, is different for each route because each route has a different length. The annual property taxes that will be assessed on this particular investment alternative is that it will be a percentage of the construction costs. It's 2% of the cost of construction. And the annual revenue, regardless of which particular route I choose, will be the same, $35,000 per year. What we need to do is to translate this problem description into its net cash flow series for each of these 3 alternative routes. And if I do so, it would look like this. For Route 1, it calls for an initial investment of $75,000 for net revenues of $23,000 per year, each year for the next 14 years, plus in the 15th year, a net cash flow of $68,000, which is the $23,000 in net revenue plus the salvage value at that time. And I can do likewise for Route 2 and Route 3. Now, I can solve this problem using any of the criteria we've talked about up to this point in the course. I could use prospective benefit and prospective cost to solve this problem. I could use future worth to solve this problem. In this particular case, we're going to use present worth. So what I need to do is to calculate the present worth of each of these cash flow series. And if I do so, it would look like this. The equation I might write to calculate the present worth of Route 1 might look like this. The present worth, when I can invest funds at 8% per year, is the $75,000 at time 0 plus the present worth of the uniform stream of $23,000 each year for the next 14 years, discounted at 8% per year, plus the last cash flow of $68,000 in the 15th year, moved back to a present sum at time 0, and I can discount cash flows at 8% per year. When I do the calculations, I end up with $136,100. I can write a similar equation for Route 2 and Route 3, and if I do so and do the calculations, the present worth for those alternatives are $122,600 and $129,300. Now, there are many individuals that would look at this result and decide that the most economical course of action is Route 1. And they would reach that conclusion by doing the following. They would say, well, in Route 1, the present worth is greater than 0, that is, as an individual opportunity, forgetting root 2 and root 3 for the moment, just looking only at root 1 and its cash flow streams, it says investing $75,000 today to receive these cash flows into the future is an economical course of action. It's a profitable course of action. Similarly, for root 2, as an individual cash flow stream, investing $125,000 today to receive these cash flows for the next 15 years is also a profitable course of action. The present worth is greater than 0. Similarly, for root 3, investing $100,000 today to receive these cash flows for the next 15 years is also an economical course of action. And in comparing these present worths, we would note that the present worth for root 1 is greater than the present worth for root 2 and root 3. And they would conclude, therefore, root 1 is the preferred course of action. Now notice, when I introduced the economic decision criterion present worth, we introduced the decision rule as simply accept an opportunity J when its present worth is greater than 0. We did not go on to say, and oh, by the way, if confronted with a series of alternatives, choose the bigger number. What we really should do here is a proper incremental analysis. That is, we know that one of the principles of doing an engineering economy study is that decisions should be based on the differences. We should take the differences among these cash flow streams and then calculate the present worth. Let's do that. Here again, I've shown the net cash flows for each of these 3 alternatives. What I need to do is the following. I will simply pick one of these cash flows to begin my analysis. It doesn't matter which one I pick. I can start with root 1, or I can start the analysis with root 2, or I can start the analysis with root 3. Just simply pick one of them, and let's determine whether or not that first choice happens to be an economical course of action or not. Let's just start with root 1. So I'll focus my attention on root 1 for just a moment and calculate its present worth, which we have just done before in the preceding slide. Its present worth was $136,100. We will note it is greater than 0, which means investing $75,000 today to receive these cash flows for the next 15 years is an economical course of action. We should accept that cash flow stream. It doesn't mean it's the final decision yet. It just says that is an economical course of action. Now what I want to do is determine whether or not root 2 or root 3 are better than root 1. So again, I can pick either of these 2 to continue my analysis. It doesn't matter which one I pick next. Let's pick root 2 and compare root 2 to root 1 and calculate its incremental cash flow stream, and it would look like this. In the choice between root 2 and root 1, it's a choice as to whether or not it is economical to spend an additional $50,000 today to receive an incremental savings of $5,000 each year for the next 14 years and incur an incremental cost of $15,000 in the 15th year. We can calculate the present worth of this cash flow stream, and it would result in a minus $13,500. In other words, it is not economical to spend $50,000 today to receive these $5,000 each year for 14 years and then incur an incremental cost of $15,000 in the 15th year. What I have just identified is we should prefer root 1 over root 2. So at this point, I could reject root 2. There is no reason to compare anything else to root 2 because I have now identified root 1 is superior to root 2. What I now want to know is root 3 better than root 1? So I will do the incremental cash flow analysis on that comparison. Here are the incremental cash flows of root 3 minus root 1, and the question is it worth spending an additional $25,000 today to save $2,500 each year for the next 14 years to incur an incremental cost of $7,500 in the 15th year? I can calculate the present worth of this cash flow stream. The result is a minus $6,800. In other words, it is not economical to invest $25,000 today to save $2,500 for 14 years and then incur an incremental cost of $7,500 in the 15th year. Meaning that root 3 is not preferred to root 1. Now, if I had more alternatives up here, if I had a root 4 and 5 and 6 and 7, I would just continue in a similar fashion, identifying and comparing to determine whether or not I could find a route that was better than route 1. In this case, we only had 3 alternatives. It turns out that route 1 is in fact the most economical course of action. You'll notice we have reached the same decision as we just did moments ago when I simply picked route 1 on the basis of the largest present worth. Turns out that present worths are additive. That is, I could show mathematically that for any 2 alternatives, let's call them A1 and A2, that the present worth that represents the difference between A1 and A2 is equal to the present worth of just A1 alone minus the present worth of A2 alone. So I could define what I will call an equivalent decision rule. Remember, the decision rule for present worth is to accept an opportunity when its present worth is greater than 0. However, because present worths are additive, I can define an equivalent decision rule which says I should prefer alternative A1 over A2 when the present worth of A1 is greater than A2. There is, however, a disclaimer, provided there is no capital rationing, meaning you have enough funds to invest in any of the alternatives that you're considering. We will soon talk about the issue of dealing with a situation of capital rationing, meaning you have less money available to invest than there are alternatives from which to choose. If the situation is one of capital rationing, this doesn't work. It works only if you have no capital rationing, you have enough funds to invest in any of the alternatives that you're considering. And oh, by the way, this also works for the economic decision criterion future worth. We just didn't introduce it at that time. Choosing the bigger number using future worth also works provided there is no capital rationing. Let's move on to the third criterion. That's annual worth. And it can be defined, again, in one of 2 ways. One way to define it is the annual amount that is equivalent to the present worth of opportunity J converted to a uniform stream using the equivalence factor, find A, given P, when I can invest at my minimum attractive rate of return, I, over n periods. Equivalently, I could define it as it is the annual amount that is equivalent to the future worth of opportunity J when it is converted to an annual amount using the equivalence factor, find A, given F. There's a decision rule, and that decision rule is we will accept an opportunity J when its annual worth is greater than 0. And that should make sense because we have just shown it made good sense to accept an opportunity when its present worth was greater than 0 or its future worth was greater than 0. If I had to give you a general kind of description of what this measure of worth is basically doing, it would be this. Basically, it says, if you were given some arbitrary cash flow stream that looks like this, That is, it calls for some initial investment, AJ0. And you are to receive some cash flows for the next n periods. This measure of worth basically says do whatever compounding and or discounting of these cash flows is necessary to make this cash flow stream look like this cash flow stream. That is a nice uniform cash flow stream. Let's take our example again of the three alternative power lines. Here is the net cash flows for each. We can solve this problem using prospective benefit or prospective cost. We could solve it using future worth. We could solve it using present worth, but at the moment we're going to use annual worth. So what we would like to do is to calculate the annual worth on each of these cash flow streams. And if you do so, it would look like this. We will do whatever compounding and